folks, let's talk about what are anti-deferral provisions. USA will only tax foreign business earnings if it repatriates it to USA through dividends. This policy is known as deferral. Deferral creates an opportunity for avoiding US taxes on passive investment income, inventory trading profits, and other income that can be easily shifted to a foreign-based company. Every person who is a US shareholder of a controlled foreign corporation during taxable year and holds its stock on the last day of the controlled foreign corporation's taxable year must include in gross income on pro rata basis of Subpart F income and investments of earnings in US property. So let's take an example. We have a USACO, it is a domestic corporation, a FORCO, which is a foreign corporation, and we assume that USACO owns 100% of the stock of FORCO. During the taxable year, FORCO drives $10 million of Subpart F income in the form of passive interest income. Income taxes paid in foreign country equal $100,000 at the rate of 10%. FORCO does not distribute any dividends. So, what is a controlled foreign corporation? Subpart F applies only to foreign corporation that qualifies as a controlled foreign corporation. A foreign corporation is a CFC on any day during the foreign corporation's taxable year when US shareholders own more than 50% of the combined voting power of all classes of stock or more than 50% of the total value of the foreign corporation. A US shareholder is any US person who owns at least 10% of the total combined voting power of all classes of voting stock of foreign corporation. All forms of ownership, including direct ownership, indirect or beneficial ownership through intervening foreign entities, and constructive ownership, are taken in account in applying both the 10% ownership test for US shareholder status and the more than 50% ownership test for CFC status. What is included in Subpart F income? Subpart F income includes following: insurance income, foreign-based company income, a portion of international boycott income, the sum of any illegal bribes or kickbacks paid by or on behalf of the CFC to a government employee or official, income derived from certain disfavored countries. What is insurance income? Any income attributable to issuing or reissuing any insurance or annuity contract in connection with the risk located outside the CFC's country of incorporation. The location of a risk is determined by where the insured property or activity is located or by where the insured individual resides. Income from insuring risks located within the CFC's country of incorporation also qualifies as Subpart F income if, as a result of an arrangement, another corporation receives a substantially equal amount of premiums for insuring risks located outside the CFC's country of incorporation. The taxable amount of insurance income equals the gross amount of such income less any deductions properly allocable to such income. What is foreign-based company income? Foreign-based company income includes following: foreign personal holding company income, And what does it include? It includes dividends, interest, royalties, rent, and annuities. Net gains from the disposition of property that produces dividends, interest, rent, and royalty income, except for net gains from certain dealer sales and inventory sales. Net gains from commodity and foreign currency transactions, excluding net gains from active business and hedging transactions. What is not included in foreign-based companies' income? Rents and royalties derived from active conduct of trade or business and received from an unrelated person are excluded. Export financing interest derived in active conduct of a banking business is excluded. Dividends and interest received from related parties incorporated in same country as CFC. Rents and royalties received from related parties for the use of property in CFC's country of incorporation. Income derived from the active conduct of banking, financing, insurance, or similar business. What is foreign-based company income? We are still doing exclusions. So another thing that you can exclude is dividends, interests, rents, and royalties received from a related CFC provided the payments are attributable to income of the related CFC, which is neither subpart F income nor income that is effectively connected with a U.S. trade or business. Under this exception, cross-border payments between related CFCs do not constitute subpart F income as long as the payments are attributable to active foreign business income. Personal service income received by a CFC whose U.S. owner performs the services is also excluded. Let's talk about what is foreign-based company sale income. It includes any gross profit, commission, fees, or other income derived from the sale of personal property which meets the following requirements. The CFC purchases the property from or sells the property to a related person. The property is manufactured, produced, grown, or extracted outside the CFC's country of incorporation by someone other than the CFC. The property is sold for use, consumption, or disposition outside the CFC's country of incorporation. What is foreign-based company service income? It includes any compensation, commissions, fees, or other income derived from the performance of technical, managerial, engineering, architectural, scientific, industrial, commercial, and like services, where the CFC performs the services for or on behalf of a related person and the services are performed outside the CFC's country of incorporation. What is foreign-based company oil-related income? It includes foreign source income derived from refining, processing, transporting, distributing, or selling oil and gas or primary products from oil and gas. Under the look-through rule, foreign-based company oil-related income also includes dividends and interest derived from a 10% or more owned foreign corporation to the extent such dividends or interest are attributable to foreign-based company out-related income. How to treat a U.S. shareholder earnings from investment in U.S. property. A U.S. shareholder must include in gross income the excess of shareholders' pro rata share of the CFC's current year investment in U.S. property over investments in U.S. property taxed to U.S. shareholder in prior tax years, but only to the extent the CFC has undistributed earnings which have not yet been taxed to U.S. shareholders. What are the principal types of U.S. properties? Debt obligations. U.S. property includes an obligation of a U.S. person such as loan to a U.S. shareholder, including any pledge or guarantee by a CFC or a U.S. person's obligation. Certain receivables. U.S. property includes trade or service receivables acquired directly or indirectly from a related U.S. person, where the obligor is a U.S. person. Stock. U.S. property includes stock of U.S. stockholder or other related domestic corporation, but not stock of unrelated domestic corporations. Tangible property. U.S. property includes any tangible property located in the United States, such as U.S. manufacturing facilities. Intangibles. U.S. property includes any right to use in the United States a patent, copyright, invention, model, design, secret formula or process, or any similar property right. How to treat deemed paid foreign tax credit for a CFC's foreign income. Consistent with the notion that a Subpart F inclusion represents a deemed dividend, a domestic corporation which directly owns 10% or more of a CFC's voting stock can claim a deemed paid tax credit for the CFC's foreign income taxes in the same year that the shareholder is taxed on the CFC's earnings. The deemed paid credit that is allowed with respect to a Subpart F inclusion generally is identical to the deemed paid credit that is allowed with respect to actual dividend distribution. How can you prevent double taxation? Distribution of previously taxed income. A U.S. shareholder can exclude from income distribution of a CFC's earnings and profits that were previously taxed to U.S. shareholders by reason of a Subpart F inclusion. A U.S. shareholder cannot claim a deemed paid tax credit with respect to a distribution of previously taxed earnings and profits to the extent of a credit was already taken for those taxes in the year of Subpart F inclusion. CFC stock basis adjustments. A U.S. shareholder increases its basis in the stock of a CFC by the amount of a Subpart F inclusion. This adjustment prevents double taxation of any proceeds from the sale of exchange of CFC stock that are attributable to earnings and profits that were already taxed to the U.S. shareholder as a Subpart F inclusion. Currency translations. U.S. shareholders must report Subpart F inclusions in the U.S. dollars. Earnings and profits. One amount of a U.S. shareholder Subpart F inclusion for Subpart F income is limited to CFC's current earnings and profits. The amount of a U.S. shareholder's Subpart F inclusion foreign investments in U.S. property is limited to the sum of the CFC's current and accumulated earnings and profits. Let's talk about what are the reporting requirements by IRS. A U.S. shareholder who owns more than 50% of the stock by vote or value of a foreign corporation must file a Form 5471, information return of U.S. persons with respect to certain foreign corporations. U.S. persons who acquire a 10% ownership interest or acquire an additional 10% interest or dispose of stock holdings to reduce their ownership in the foreign corporation to less than 10%, and U.S. citizens and residents who are officers or directors of a foreign corporation in which a U.S. person acquires a 10% ownership interest on an additional 10% interest should also file Form 5471. What information is reported on Form 5471? It includes stock ownership, including current year acquisition and disposition, U.S. shareholders, details of U.S. shareholders, GAAP income statement and balance sheet, foreign income taxes, current and accumulated earnings and profits, including any actual dividend distributions during the year, the U.S. shareholders' pro rata share of subpart F income, and any increase in earnings invested in United States property, transactions between the CFC and the shareholders or other related persons. A Form 5471 is filled by attaching it to the U.S. person's regular federal income tax return. U.S. person who fails to furnish the required information may be subject to an annual penalty of $10,000 and also a reduction in taxpayers' foreign tax credit. Folks, this information is for educational purposes only. It does not constitute any legal advice or opinion. Please do not use any of its contents without seeking a professional advice. I have prepared this information and this lecture from Practical Guide to U.S. Taxation of International Transactions, 9th edition, written by Robert J. Missy Jr. and Michael S. Shadewald. Publishers are Walter Kluwer, CCH Incorporated. My name is Mansoor Suhail. I'm an accountant operating out of Toronto, Ontario. My specializations are taxes for Canada and USA. Please, if you have any question, call me at 416-283-8774 or contact me by email at taxservicesguru@gmail.com. And folks, visit my websites at www.theaccountingandtax.com or www.taxservicesguru.com. Thank you for listening.